Hello, everybody. We're going to give this a minute or two to let folks roll in, and we'll go ahead and get started. Well, thank you, everybody, for joining us today. We have some really good information to go over with regards to tax planning and year-end tax planning, and I want to say hello to our special guest, Derek Smith.
Hi.
Derek's a partner with BodinePerry, and we will be going over a whole lot of really awesome information about just some things to consider for year-end taxes, as well as kind of what's the tax landscape moving forward. So thank you all for joining, and for people who can't catch it live, we'll have this on the website later today for anybody to watch at any time. Also, just a reminder, there is a chat button that you can use, or the question and answer button to ask any questions, and we'll try to get those answered along the way. But thank you for everybody's time, and hopefully you'll find some of this information valuable. So Derek, thanks for joining us today.
Well, I'm glad to be here. It's always fun to talk about, things to do, lots going on in our world on the tax side. So it's always an interesting time.
It is. Yeah, I think last year we were remote when we did our year-end one, so it's nice to be face to face again. So.
Yes, at least for the time being, right?
I don't know if much has changed since then, or will change in the future, but still, it's nice to be face to face.
It's always good to see you, Josh.
Absolutely. Well, so I thought we'd talk a little bit about some of the items that you had on your agenda, and if you want to just give a brief introduction.
Sure. So, I am a partner at BodinePerry. We are a 7-location practice in Florida, Ohio, and Pennsylvania. Those of you who may remember last year I came on, I was one of the partners at Mark Fitzdugan Associates. We're excited to announce we had a merger this year, and so we became part of BodinePerry. BodinePerry does not have a Pittsburgh office, so we became the Pittsburgh office of BodinePerry. Really excited by what we can offer to our clients and our staff with this change. But even though my name has changed and my title has changed a bit, what we talk about this time of year has not changed at all. This is tax planning season for those of us who are tax geeks. You might think the tax return preparation season is the time of tax geeks. It really is not. Once we prepare a tax return, there's not much we can do. Decisions have been made, things have been done. The numbers are being filled in by the computer, and there might be some choices we can make, but they're pretty limited. But this time of year, my goodness, there is so many choices to do. There's so many different levers to pull. It's a really, really fun time of year. On that point, I'll probably prepare about 100 tax plans right now. For businesses, for individuals. I just did one for a client who's looking about a Roth roll, how much they should roll and what the amounts they should do that. And that's just a everyday person with an IRA and some income and wanted to figure it out. To my business owners that are trying to figure out if they should buy a heavy piece of equipment before the end of the year, if they should pay their bonuses, if they should make that plan, make an additional contribution to their retirement plan, all those kind of things. So it's a really exciting time for us because we get so much done. The main reason we do this, though, is we never want to say to a client, did you know?
Sure.
Did you know you could have done that? Did you know you are going to owe it $100,000? I always say to a client, it's always fine to know you owe $100,000 because that means you made a lot more money this year than last year. But the problem is not knowing. Right. So we want to make sure that no client ever gets that "did you know" kind of comment. And tax plans are great because we can figure out where we stand and where we are when we get done with that tax plan. And you rarely have that "did you know" unless something surprising comes out of left field.
Absolutely. Well, maybe we start with something that we don't really know, but everybody wants to know, which is for the second year in a row, what the potential Biden tax plan changes could be, maybe will be, right, possibly would be. It's something that obviously people have been wondering for quite some time. It's almost the end of 2021. We haven't seen really anything change yet. Right. But why don't you give us a little bit of rundown of maybe like where your ideas are for what might happen or what might not happen?
Yeah, sure. When I gave this a similar talk like this about a month ago, Josh, and of course at that time there was this whole question of, well, would it happen before the end of the year? Would it take place before the end of the year? There's been this sort of movement and push inside by our politicians that when they make a tax plan happen or changes the tax law, they often do it the date they do it rather than retroactively or future facing. I think at this point, and we were saying back in November, we felt pretty comfortable whatever changes are made, we're going to be 2022 going forward. I think at this point on December 7th, we can feel with some confidence that that's going to be the case, that we shouldn't see too much happen. But number one item is that if you make less than $400,000, and that's whether in capital gains, investment income, compensation, whatever it may be, if your adjusted gross income is less than $400,000, President Biden has said that there'll be no changes in your taxes. And I'm pretty certain that will be the case. I'm pretty certain that will run through.
Yeah.
Most of the changes that we are been talked about, most of the changes that they're dealing with, have all been for incomes item over $400,000. There are some things in the estates that may affect people who make less than $400,000. There are some things in the corporate side that may affect people who make less than $400,000. But for most people, if you make less than $400,000, we don't anticipate many changes. And the reasons behind that really is because most of the money raised on taxes is raised in the higher brackets.
Right.
You raise 5% of you raise an income tax of 5% on someone who makes $1 million and it's on the last 500,000. You've just raised a significant much more money than you would be if you raised 5% on someone who makes $100,000.
Sure.
So I think that the thought process is, and then number two is that there's less people in that bracket. So from a political standpoint, you're dealing with less votes and possible negative votes from a political standpoint. We go back to history. In the last few tax acts, we've seen that to be the case, that anyone over the $400,000 level and the higher income levels have had taxes raised. The Obama Tax Act did that in 2014. They raised just the upper brackets. That was the only change that was made. And then a lot of the tax benefits are happening in the lower brackets. So we'll see that.
What proposed changes do you see for people who are in that potential $400,000 above range?
Well, I think the first thing is the tax rate increase. Right now, the top tax rate is 35%. We could see that going to 37 or 39.6. I think that would be the first major change we'll see. And that's really for people who make more than $510,000.
Okay.
That's where that bracket starts. That's that 5% change I was just talking about. So I think that will be the number one thing. We've seen that happen before. In President Bush's Tax Act in 2001, I think it was, he lowered that bracket to 35%. President Obama raised it back up to 39.6 when he made his changes. So we've seen this Republican-Democrat swing happen time and time again, and this is one place they tack almost every single time.
What about capital gains?
That's a big one, and that's the one I think holding up probably a big portion of this tax act.
Yeah.
So right now, the conversation is that if you make more than $1 million, you could have ordinary income tax on your capital gains. Now, those of you at home who don't know what the difference is, right now your capital gains are taxed at either 15 or 20%, depending on your income level. If you have $1 million, it'll be 20%. And so this could move it from 20% to 39.6. So it's almost a 20% increase. And that's not necessarily going to happen to everyone, but it may happen more often than you think. I was telling a story when I was at my last seminar, Josh. My parents live in California and they own the house. Their house, under our current tax code, the first $500,000 of the basis of the gain of a house is tax free. So if they sold a house, and in California this happens, or New York or Texas or Florida, they sold a house for $3 million, they bought for $1 million, they would have $2 million of capital gain. The first 500 would be free, right? So they have $1.5 million. Now they are ordinary people with Social Security and IRA, maybe never make more than $400,000. Now they're over $1 million, and everything over that $1 million would be taxed at ordinary income tax rate.
Right, and you can't spread that out.
No, it just happens.
Sure. Yep. That's interesting. It's not just stocks and bonds.
Right. Exactly. I might just tell my parents to hold it until they die at this point, if that's the case.
Sure.
But that's a totally different story.
Is that something that could change?
Well, that's interesting. Yeah. So that is one of the things they've talked about. One of the things they've talked about is low. Right now, the exemption limit is $11 million. So if you die, if someone dies and have an estate that's worth $11 million or less, then they won't have to pay any tax on that. They've talked about lowering the exemption level. It was $1 million for many years. Went up to 3, went to 5. Could it go down? Yes, and that could be part of it. The other piece of that, which is kind of an interesting one on the estate stuff, is that they've talked on any unrealized gains greater than $1 million being taxed to death as well. So again, that that plan of me having my parents hold their house until they pass may not work anymore if those things pass.
And that's at death, not while you're alive for unrealized
Correct.
taxation.
Correct.
I know at one point that was tossed around, but it doesn't
Yes.
seem like that gained much traction.
No, it didn't get any traction at all. I think it was a logistical nightmare. The first thought, I'm sure the IRS was quaking in their pants at the thoughts of having to track unrealized gains. And then the investment houses, I'm sure, did not want to do that. But yeah, that never got any traction. I think that was pretty much dead in the water on arrival. So,
Right.
But this is something that really could happen. Right now, if my parents die and their house is worth $3 million, my basis is at $3 million.
Right.
If I sell it tomorrow,
that's what's called a step up.
that's the step up. Thank you. That's the step up in basis. If they die, if I sell it the next day, I capital gain to zero.
Mhm.
So this plan would say that I would still have it, could have a $2 million capital gain. In theory, it might be better for my parents to sell it when they're alive. In this case, at least they get the $500,000, step tax-free basis.
Right.
So it's really an interesting sort of piece that we're going to be looking at as these things are passed from a planning standpoint and a piece standpoint on that standpoint.
How likely do you think that any or all of these would be passed?
The estate limit, I think, will absolutely go down. I think it's too high. I think that
11 million.
11 million, right. The current talk we've heard is it's going to be halved. It's going to be closer to 5, I think.
Just still a lot.
It's still a lot for probably
most
more
people.
for most people. There's a little known thing called portability. That if my mom dies first, and we can do a portability adjustment, which means my dad will actually have a $10 million estate limit, not a $5 million, assuming the assets transferred from her to him.
Right.
So there's still a good chance we can do it. This $1 million unrealized gain tax is really kind of scary though. And not, it's one of those sneaky little taxes that I could see get slipped through in exchange for something else not coming through.
Right.
Maybe like the $1 million, maybe they get rid of the capital gain, ordinary income capital gain. That the Republicans exchange that in exchange of this or something like that. Right. And it's a sneaky little tax that gets slipped through. People will not be aware of it. Right. If they're not working with a professional advisor and doing estate planning, may not be anything aware of it. And going back to my parents, for example, I hope my parents are actually proud of me for using them throughout this presentation. They're good Jewish parents; they'll be fine with it, right? Not
just houses, family businesses,
exactly. Any of those things could come into play. You're absolutely right, but it's definitely, if you're not working with someone on your estate planning and stuff like that, you could really get caught unaware if that passes.
Right. Sure, absolutely. Did we talk about corporate tax rates?
Not much. The corporate tax stuff is a little less prevalent. Most of our clients are what are called S corporations. Mm-hmm. That means the income passes directly from the businesses to the owners, so they don't pay corporate tax rates. Right. Corporate taxes are often paid by the bigger companies, the Coca-Colas, the Home Depots, those kind of companies of the world, the Apples, not by the smaller companies.
Right.
So when we deal with corporate taxes, we don't really see it as much from a personal standpoint. Currently, corporate tax rate is 21%. It's the lowest it's been in years. It was 35% under Obama, and it had been that way for 30 years, as far as I can remember. Mm-hmm. And President Trump lowered it to 21%.
Right.
The current Biden tax plan raises it to 28%. Right. And also adding what's called a minimum tax, which means that there would be a minimum amount every single corporation would have to pay if they have income.
Right. I'm willing to guess most people didn't think the corporate tax rate would stay indefinitely at 21%. That's pretty historically low.
And the interesting thing about is from a Pennsylvania standpoint is that Pennsylvania has one of the highest corporate taxes in the nation at 10%. So even though the corporate federal tax rate went down to 21%, it still didn't make sense for a lot of our S corporations to become a C corporation, because between the federal tax of 21 and the PA tax of 10%, and so the combined rate of 31%, and the fact the only way to get money out of a corporation is their dividends or wages, most C corporations still were better off as S corporations. So it's in our area, in this Pennsylvania area, it didn't even take hold as it would be in maybe some other areas that would maybe affect this. If the 21% went to 28, they have to think about what they want to do about that.
And although maybe not directly correlated to individuals, certainly companies paying more in taxes could have a change in their likelihood to provide extra benefits, 401k matches, wages, things like that. So,
and I'm sure if they're paying more in taxes, their costs are going to go up, and their prices may go up, as we're seeing right now, just for other reasons.
Yeah. Maybe we can talk a little bit about the child tax credits. We've gotten a lot of clients from questions about, hey, what are these payments hitting my account? Should they be? What do I do with them? Do I get to keep them? How does that work?
Right.
And this, I think, was one of those things that through COVID was just kind of thrust into action.
Right.
So maybe you could give a little bit of a.
So the child tax credit was something that was implemented a number of years ago. And originally it was a $500 payment for a kid. I think it was actually maybe President Bush's tax act. I might have implemented it. So it was $500 if you had a kid under 16, and you got that $500. President Obama, when he came into office, raised it to $2,000 for a kid, and $500 if your kid was under 16, over 16. Sorry. And again, was not a big change because the limits on the child tax credit were about you had to make basically less than about $150,000 for it to come into play. So a lot of people got it, but there were a lot of people who didn't. Under President Trump's tax act, he raised the limit up to $400,000 to get this credit. Suddenly, there was a whole slew of people who never got this credit, suddenly getting this credit. And it was the same amounts, $2,500. So you had people with 3 kids under 16 getting $6,000 and making their $400,000.
This is a credit.
This is a credit. Exactly. This is, right. For those of you watching at home, a credit is a dollar for dollar deduction against your taxes, reduction of your taxes. So if my taxes were $6,000 and I got $6,000 of credit, my tax liability is 0. So that went along very smoothly. A lot of more people got it. Well, under the latest tax act that was passed in December, 2 things happened. If you have a child under 6, you could get up to $3,600. Between 6 and 17, you get up to $3,000 if your income was under $150,000. So that's great. Gives more money to people in those lower brackets. The other $150,000 to $400,000 stayed the same. But what happened is that what they want to do is get this money into people's hands so they didn't have to wait for tax return file.
Right.
So they started a program that if you had on your 2020 return, you got these credits and they know how old your kids are and they know where they stand. They started directly paying you for the amounts. Couple issues on this that we think of. Number one, if you are going to get it every single year, that's great. So I don't really have a problem. But most of my clients have 1 or 2 things. Number one, they use this money, or their business owners, they use this money, this credit to reduce their taxes. So in having to spend, instead of paying a $15,000 estimate, they might be paying $11,000 estimate. They have 2 kids under 16. So when they get paid this money, it just means that we're going to have to pay it back at the end of the day. Anyone who's making tax estimates and other things like that know they're getting these credits and reduce it. Same thing if we have 2 household earners. A lot of times one of the earners is not having as much withheld, and we know these credits can make up for that. So if you're getting paid these credits and you're using them to pay off your taxes, you'll end up having to pay it back with possibly penalties and interest because you may not have enough payments paid in for you. That's number one.
So you're not losing it, but you are not taking it in consideration with how much you're paying in throughout the year. So you could end up owing because you got it early.
Right. That's right. That's right. So, I think that I'm a little worried for clients who are generally using the offset items, that they're going to get this money and get a surprise tax bill at the end of the year. And
it's very possible.
Right. And that's possible. The other one is I had, in 2020, we had a lot of clients who lose their jobs, who came unemployed, or their businesses didn't do as well, and they didn't have the normal income patterns. 2021, we're seeing some of the return to that income pattern. Maybe they got another job, maybe they had some things. And so while they may have qualified, let's say, for the $3,600 number in 2020 because of the lower income, on their new income number, they may have only qualified for $2,000. They'll be $1,600 overpaid, and they'll have to again pay that back when we file their taxes.
Because the IRS doesn't know until
you file your taxes where you're going to be at. Yep. And so we've had a number of clients call me and say, "Hey, I know that my income was really down last year, and now I started getting these payments. What's going to happen?" I'm like, "Well, you're going to have to pay them back." So our advice is to stop.
Okay.
So generally, our advice to clients have been when they receive the payments, unless we know that they're not going to use them, is for them to stop making the payments.
How do you stop?
It's actually pretty simple. You can go on the IRS website. You go through there. You can set up an account through their website, and pretty much request that they stop making the payments.
And you can view all of your previous payments, and they'll tell you exactly how much you've received, where they're going. The website's pretty user friendly.
Yeah, it's not like for a government website, not too bad.
Once you figure out how to log in and view it, a couple clicks through, and from what you're saying, you can opt out.
Yeah, you can opt out. Actually, and that's just a segue. It's setting up an IRS account for yourself online is not a bad idea. You can view what payments you've been making, what income's in there. If you can't find a 1099 dividend, let's say from an investment, and rather than going to the investment house, you might be able to find that through your wage and transcript information on the IRS website.
And let's just clarify, if you do opt out, you're not opting out of receiving the credit if you're eligible for it. You're opt out of receiving them in advance.
Correct. If you're still eligible, if you're still allowed to get it, you will get it on your tax return.
Right.
It just allows you to not have to necessarily pay it back or get hit with unfamiliar tax bill. Look, we have clients, I'm sure you do too, that have 3 kids under 6. I mean, that's over $10,000, $10,800 of credits.
Mm-hmm.
If for some reason they don't get it, for some reason they sold a house, had an unexpected capital gain, something happened they weren't expecting, they'll have to pay that $11,000 back.
Sure. Or I guess even on the flip side, if somebody just happens to like to get a larger refund, maybe it's one of those ways that they get some forced savings or a smaller windfall later on. Instead of getting it monthly, they could
a lot of clients
take it as just a refund at the end of the year.
A lot of
when they
clients use
file
those
their
refunds to pay their property taxes, pay their income taxes, pay other different things that kids' school bills, So without that, you'll have that much less money to do that.
So as far as potential tax changes, there's certainly a lot of debate, and it's not going to end, I suppose, until the legislation actually happens. Anything else that you think that's on the horizon with regards to change?
Well, I think the other thing inside of the individual taxes that we're really keeping close eye of, because we have so many business clients and so many business owners, is the qualified business income deduction. You'll heard it said is QBID, and QBID is something business owners can get. It's almost like they get a 20% of their business income tax rate.
And these are for those pass-through entities. That
correct. The S corporations, the partnerships, exactly right.
Mm-hmm.
There is a lot of talk that there may be the reduction or removal of any QBID for people who make more than $400,000.
Okay.
So you have a business owner who's a manufacturer who makes more than $400,000 could lose this. It's a pretty big piece of the tax plan and a pretty big piece of the tax savings.
Right.
Obviously, we don't want to necessarily cry too much for them. They are high income earners. They make a lot of money, but they also do pay a lot of taxes. And and it's one of those things that we just going to have to look at and be aware of, and think about how we're going to do it.
And this is something that may not necessarily or won't necessarily impact like the big companies you had mentioned before, Home Depots, but this would be more targeted towards small businesses. And although $400,000 is not, a small sum of money, it is more targeted towards like small and medium-sized businesses.
Correct. And so, the 2 other things that I really think are interesting that could come down. So right now there is, when President Obama passed his tax bill to help pay for the government healthcare, he created 2 different taxes. It's called the net investment tax, one which is a tax based on earnings and or compensation, and another one based on unearned income, dividends, interest, capital gains. In that creation of that tax, the pass-through income from like S corporations and partnerships, if they weren't compensation, if they were just doing business income, was exempt from the net investment tax. So I could pay someone a little less than they were required to, or that I was thinking about doing, and then I could get rid of some of that net investment tax. This tax act also talks about putting that on any income earned or more than $400,000. So again, that business owner has a pass-through entity that makes $1 million, might actually end up paying about $29,000 more in tax than they did before.
Okay.
So that's a little bit scary on that standpoint too.
Sure.
The final item I've heard a lot about, on the campaign trail, President Biden talked about increasing the FICA limit for anyone who made over a certain amount. And that amount's always been $400,000, around this $400,000. There is nothing in this tax act on that has seemed to be shelved and taken off the table. Not saying it won't come back, but basically what he's saying that if you make more than $400,000, a 6.2% Medicare tax would stop right now at about $150, would come back into play.
Yeah, that's a 6% difference.
And it's a big difference. It's a big difference for a lot of people.
Mm-hmm.
So it would be a big change if that had happened. In my collective memory, it's always been capped at a certain number. So
I think with the limit right now is 140.
142.8. And then it goes up to 147 in 2022.
Okay.
So that would be a big change.
Big change.
And again, going back to the C corporation, S corporation, planning how to do things, it would be another reason why we look at, as a tax accountant, trying to figure out what is best for our clients, our business owners, or otherwise. Is there other ways to pay them to help them save the money on this?
Sure. So we talked a lot about things that we don't necessarily know whether or not they'll come to fruition or exactly when. Perhaps many of them will. maybe some won't. But what are things that we can do today under current rules that we may be able to take advantage of right now?
Yeah, definitely. There are certainly things we talk about right now. Probably the number one thing we talk about. So when President Trump raised the standard deduction limit to $25,100 that it is this year, a lot of people weren't able to itemize their deductions.
A lot.
Which also meant a lot of people
It's
weren't.
a bad thing.
Hey, the IRS loves it. I'll tell you that. There's a lot of people who are just that take the standard deduction and move on who didn't before. So the IRS is very happy, reduces their audit risk, reduces the people they have to audit. There's no doubt about that. But I'd say the one thing that really worried a lot of people and came to true was the charitable contribution. You never got a deduction for charity. You weren't getting a deduction for charitable contribution. And unfortunately, we all like to think we give charity because it's the right thing to do, right, Josh? You know, but unfortunately, there are a lot of people who say, I'm giving this because of the tax deduction.
Right.
And so when they're doing this charitable contribution, they weren't getting a tax deduction. Under the 2020, on the 2000 and the Tax Act that paid in May in 2020, it allowed a married couple or an individual to do up to $300 pre-tax. Essentially, it was an above the line deduction before you adjusted gross income of a charitable contribution. In 2021, it's $300 per person. So a married couple could actually give up to $600.
And still take the standard deduction. So if you are a person that typically gives $500 a year, you'll get that $500, but next year in 2022, you won't. So maybe accelerate an extra $100 this year to get that into 2021, so you get the whole $600. Right.
If you are a person that was on the fence about doing it, or have stopped giving as much because it's not a charitable contribution, give up to $600. You'll get a deduction for it at the end of the day. So that's number one. Health savings accounts. One of my big pet peeves. If you are in a high deductible plan and are not giving 100% to your health savings account, it is, in my mind, a mistake. I have a friend that calls this the best investment he makes every single year. Immediately, that person gets, if you put money in a health savings account, you immediately get a 25 to 30% return because you get it's deduction for federal and Pennsylvania taxes. That's a pretty good return on your money right away.
Sure.
And you don't lose it. Those of you who remember who are maybe have a medical savings account at their work realize they have to use it at the end of every year. Health savings account you don't have to use.
Right.
It stays with you. It grows. It actually there's some sort of investment component too. You can actually put in some investments and some things like that. And so I have clients that will fund their health savings account and use it for if they have a big medical expense later in life.
It can even be used for Medicare payments. Right?
Yeah. So I think that there's a lot of good possibilities on that. As we get older and we need to have more surgeries, or we want to get cataract surgery or something that may not be covered, or something else that might be covered. I joke my hair plugs that I won't get at some point, and I can use that health savings account, and it won't actually affect me. It won't affect my everyday cash flow.
And even if you're not using the contribution in the health savings account to fund a medical expense in that year, you're still getting a deduction.
Exactly. You're in the money you don't lose it. That's people are always afraid they're going to lose the money.
The FSAs, flexible spending accounts, you would lose,
but not a health savings, not the health savings account. So no matter what, I always recommend to clients fund it every year, whether you have it or not. It is such a great deduction.
It is. And
you have until April 15th. So it doesn't have to be done by the end of the year, but it's certainly something we want clients to thinking about if it is a cash flow issue. I mean, the contribution is over $7,000 this year for a married family. It's a married couple. Or a family.
On a family plan.
Family plan.
Right.
So, so it's a little bit of cash flow issue for some people. So we want to make sure they think about that and how they can get that done.
And that money is going into the health savings account with a tax deduction. And if it's growing, so say it's earning interest in a savings account, which is usually the default option, or if you were to invest that money, which most HSAs have the ability to do anyways, that growth is also tax-free when you pull it out. So you're paying pre-tax and you're taking it out after tax. And I don't really know of any other tax shelter that you can do that with.
Yeah, pretty much probably just a Roth is which
actually Roth is after tax going in.
Right, after tax. So that's true. That's right. Exactly. You're right. Absolutely right. Exactly right. And think about it that way. You're absolutely right. Yeah, it is. That's why my friend always calls it the best investment he makes every year.
Well,
I know I'm saying that to an investment advisor. You probably don't hear me say that, but it is truly a great investment from a cash flow standpoint.
I agree. So absolutely.
On that note, Roth Rolls. I'm a big believer in Roth Rolls.
Could you explain what that means?
Yeah. So what a Roth roll is, a few years ago, you had to make less than $100,000 to roll money from your regular IRA to a Roth. They took that away over a number of years ago. And right now, at any given time, any single person can roll money from their regular IRA to a Roth. A conversion, right? Not a contribution, a conversion. You don't have to have compensation to put money into a Roth. I have to have compensation. I have to make less than a certain amount of money.
Mm-hmm.
Both have to happen. A conversion doesn't need that. I can convert at any given time my IRA money.
There may be taxes on that,
but there will be taxes, most likely. And that amount you pay at that point. Mm-hmm. The benefit is, though, the long-term benefit is that I'm now sheltering those monies from any future taxes, including any future tax increases. Right. In regards to estate planning, even though it counts against my estate limit, my heirs don't have to necessarily take out the money immediately and pay taxes on it like they would on a regular IRA. They will have to take the money out because the Roth doesn't live, but it becomes after-tax investment money at that point. There's no taxes owed on it.
Sure.
So it's a really great way of looking at different opportunities to lower the future taxable income of our clients, the future taxable income of their heirs, and in this uncertain tax environment, to lock in taxes at a rate which is historically pretty low. It's really a nice way of doing it. We do it, and Josh, you may think, well, I'm only doing it for the low income clients or this. We just did a Roth roll for a client that makes almost $1 million a year. They are going to, shelter a lot of money over the course of time. They're going to shelter it's more for the heirs. They have way too much pre-tax retirement money, and they just wanted to get some of it out of there. And them and their investment advisor made that choice. So they paid a lot of tax. Don't get me wrong. Sure. But it's a kind of a double benefit in a weird sort of way, because they paid the tax out of their after-tax investment accounts that reduced the taxability of future earnings that they're going to have, and sheltered it into the Roth. So it's kind of a nice benefit. It's painful. They were not happy about the check. I won't say that. But
the benefit really comes by paying with money outside of the Roth.
Absolutely. You really can't use the Roth. I mean, then you're just shorting the future growth of it. So, right. But we do talk about, it's interesting. I had going to Roths, and I know we're sidetracking a little bit here, but Roths I kind of joke, can be almost an emergency savings account for someone. If they have the ability to take the money, if they're over 59 and a half, and they've had the Roth open for more than 5 years, they're better off putting money in a Roth and letting it grow tax-free than putting $30,000 into it, an after-tax savings account that's earning 0.1% at this point, right? If I took $100,000 of IRA, rolled it into a Roth, I now have $100,000 of emergency money in case I needed that. I can pull out at any point tax-free, paid the $30,000 out of my investment account, and I just made my emergency fund from $30,000 to $100,000, sure, and can grow at a much better rate than it would be in the investment account.
And although maybe not ideal, even for people younger than 59 and a half, their basis, so their contribution amount wouldn't be penalized either for
Agreed, 100%. The $100,000 could be pulled out on an emergency basis as well. So there's lots of good benefits for Roths, that not just from the tax side. There's a lot of future things that you can do with it that are really kind of cool.
Still eligible for backdoor Roth conversions, and I always wonder when they're going to close that loophole.
Yeah, those are becoming harder and harder to do, just because one of the things that a lot of people don't realize is that you can't do a backdoor if you have any IRA money.
Right. And
that gets caught up a lot of times with people that they got, and again, sometimes they don't even remember. Oh, I forgot I had that IRA from that past 401k that I rolled in. That's $100,000, and the backdoor doesn't work.
Right.
So it's really hard to work, because you got to have no IRA money.
Well, the 401ks are exempt.
The 401ks are exempt. I would say, so a lot of times we advise clients when they're leaving a job to roll their IRA money into their new 401k, or their old 401k into the new 401k, so it doesn't show up in the IRA, so they can still do the back doors. But it is hard to do because of that problem that if anyone has that, you kind of do it.
Or convert the remaining IRA money.
Absolutely. We've done that too.
Window.
We have done that too. We had one client, it didn't have a lot of money in an IRA, about $20,000, and it was screwing up the back doors every single time. Yeah. And we just said, why just convert it and be done with it? Okay, you'll pay $6,000 in tax, and then we're done. And that's what they did. Yeah. And then it worked until they got another $100,000 from somewhere else. But it worked for a while.
Yeah, sure. Anything else?
Yeah. So, in this sort of genre of retirement accounts and IRAs, qualified charitable distributions. These are if you're required to take your RMD, this is the best way you can give money to a charity right now. A qualified charitable distribution is giving money directly from your IRA directly to a qualified charity.
So this kind of goes back to, if you lost the benefit because you can no longer itemize, you're going to have to pay taxes on a required minimum distribution from your IRA. Maybe you use that money.
Absolutely.
And although you're not taking a deduction necessarily, you're saving the taxes,
Correct.
which essentially is the same thing.
Exactly the same thing. And actually, if you can't get the itemized deduction because you're taking the standard deduction, this is a way you can actually get a deduction for it without getting the deduction, which is great. Even if you're getting the itemized deduction, I still like clients to do this because it comes out of their adjusted gross income. So like for Medicare planning, where Medicare is more expensive, the deadly IRMA that my dad always talks about, if his income goes over a certain level, his Medicare becomes more expensive.
Right.
This will come against that, and so it will help keep that money below that Medicare limit. As well as some of these other things we talked about, the net investment tax, capital gains. It could really come in handy. So if it's not something, if you are over 72 and a half and are taking RMDs and are not looking at this is definitely something to talk to your investment advisor about, because it is a great program. Everyone should be taking advantage of it, whether they are in that place or not. So,
yeah, we got so much into it, I forgot to look at some of the questions here. So maybe we'll pull up a couple questions.
Sure.
All right, so let's see here. If you get a 1099 for your state of residence, and if you provide services out of your state of residence for 1099, are you required to file a tax return in the out-of-state states?
Yes. So obviously, unless you're in a state that does not have an income tax, Florida, Texas, Washington, Tennessee, New Hampshire, I can't remember all 7 of them. I'm trying to get them as close as I can. Nevada. So if you provide services in a state that out of state, so you're a Pennsylvania resident, you're working in another state, then most likely you will have to file a tax from the state. Now, there are what's called reciprocity rules between states. Like if you work in Ohio and live in Pennsylvania, you do not have to file Ohio return because there's a reciprocity rule. So you record that income in Pennsylvania. Same thing for like Virginia and Pennsylvania. So you have to look at each state to see if the reciprocity rules are there. But if they're not, then yes, you would have to file a return. You would pay taxes in that state based on that income, and then you would credit those taxes against your Pennsylvania taxes. So you wouldn't be taxed twice. I mean, the people are always worried about that double taxation, but you would get at least the credit. So if I had $10,000 of income, I was working in California, I paid about $1,000 of tax on that, I would get a $300 credit in my Pennsylvania tax. I wouldn't get $1,000 because it's not, Pennsylvania tax rate is 3%. I would get $300. Now, I'm also live in the city of Pittsburgh, and I also get that $300 from the city of Pittsburgh.
Okay.
Same thing if I made $10,000 in the state, and the income tax was $200 on that $10,000. Then I would only get a credit for $200 Pennsylvania because it's the lower of the tax rate or the amount of taxes paid. So you don't get double taxed, but you do have to file that other state one.
Makes sense. What was the child tax credit under President Trump?
It was $2,000 and $500. The same amount. The difference is under the new tax act was the increase of the $3,600 and the $3,000 for the kids under 6 and under 17 if you were making under 150. That was the main change that came out of that. So getting more money into the lower income earners is what the plan was.
Okay. And then if you put funds into your HSA in 2021 prior to April 15th, can you use it for a 2020 deduction? Also, what is the limit of tax deduction contributions you can make?
Yes. So as long as it's done by April 15th, it will be a 2020 tax return. 2020 or 2021 tax return deduction, because we're talking about April 15th of 2021. Right? He's asking for a 2020 deduction. So if you put in, so I guess this person's asking, he put money in prior to April 15th, but it sounds like he didn't get his 2020 deduction is what he's saying to me under that question. Would you say that, Josh? Because
well, let's give a couple examples then. So let's say I have, well, the deadline for an HSA contribution is when?
April 15th. So as long as I do it by April 15th, I can do it for the previous tax year.
So you can do a prior year HSA
Correct.
Contribution up until April 15th, or when you file your taxes.
Or when you file, well, yeah, I file taxes.
So if it's February, March, or April of 2022, and I make a contribution prior year,
yeah,
can I use a 2021 medical expense? I would say yes.
Yes, absolutely. Because It's about it's about when the expense occurred. So now each HSA is going to have their own rules about when you can take the money out based on when your expenses. I like my personal HSA doesn't care. As long as I incurred the money, whether I incurred it, I get to take the money out as long as there's money in my HSA.
And some of that record keeping is on the responsibility of the HSA
Correct.
owner. So if you paid a bill out of pocket, you could take a reimbursement to yourself. Just keep the invoice, and if you were ever going to need to prove
the thing I think what's going on here is that a lot of times there's a form that you get when you make an HSA contribution called a 5498 SA, and that form shows the amount of your contribution.
Right.
Some HSA providers give that form out at the beginning of the year in January, and that may not show your contribution because you haven't made it yet, right? If you're going to make it April 15th, that's going to come out before you made a contribution. So if you gave that to your tax preparer, they may not know you made a contribution. Now, if I go out and make a contribution by April 15th, even though it's not on that form, I still get to make the deduction. Now, in theory, the HSA provider will probably issue me a new form after I make the contribution that shows that that contribution is made, because that's what's going to the Internal Revenue Service. That's the form that they get that shows that that matches up and you had a contribution. So that's why a lot of HSA providers actually don't issue those forms until after April 15th, because when you ask a client for it, like, I don't have a copy of it, because they're waiting to make sure they don't want to do it twice.
Right. So if you're making a prior year contribution, you can certainly use an expense from that prior year to wash that out. Is the standard deduction the same for 2021 as it was for 2020?
It's a few $100s higher. It's $25,100 for a married couple. It's like $400 higher, $300.
And for 2022, did they say?
I don't know if they've had it. They'll go up a little bit. It always goes. It is always index inflated. They have not come out with a new number now. With them coming out with a pretty high limit amount for the Social Security limit, Social Security adjustment, I figure that this will go up more than its normal $300, $150 numbers. So.
Right. So yeah, Social Security recipients received a nice increase this year.
Thomas says, come back to us with the clarification. Right. Yes, you can, if you put it into by April 2022, April 15, 2020, you can use it for your 2021 tax.
Right. Right.
So, but again, that I think his previous question is actually a really good question as well. Don't always trust that your accountant has your tax return has the information. Check your tax return. If you know you gave a contribution, they may not have the form that shows that. If you didn't tell them that, or they don't remember, look, I'm not trying to bash the tax preparer. We do so many returns; they go in and out so fast. It is sometimes hard to catch everything at the end of the day. We do count on our people who look at the returns and say, "Hey, I had an HSA contribution. Where is that?" And again, if I had the tax form and it's not on the tax form, and you didn't tell me, there's no way for me to know.
Right. So one nice thing that I know that your firm does that we like is if we had done something the prior year, and you don't see it the current year, you'll bring that up. Correct. Because that's pretty obvious. Hey, you normally do this. We didn't see it this year. We should check on that, but maybe not all.
Well, it's funny you should say that, because we've had the situation where suddenly we'll get a 5498 SA that shows a contribution, and I'm like, oh, great, you made your contribution, and the person will say, well, I did that the last 3 years, and we're like, well, you didn't tell us,
right?
So we didn't know because it wasn't on the previous year, so you didn't tell us it was there. And you didn't obviously look at your return close enough to tell us it's not there. It's obviously, I'm not trying to blame the client. It's a teamwork thing, right? At the end of the day. Right. So luckily we can go back and adjust those and amend those returns, but it's not the prettiest thing, obviously, in the day. But, but you're absolutely right. If we know it's there before, we're going to look at it to make sure it's there. If we don't know about it, it's impossible. And it's on the tax form, it's impossible.
I'm going to guess more employees are utilizing HSAs now than ever before, because as medical costs and healthcare costs have gone up significantly, remember that HSAs can only be used for high deductible plans, which generally have lower premiums. Right. So I think a lot of employers have been shifting from very high premium plans, low deductibles, to higher deductible, lower premium plans, which are then potentially eligible for an HSA account in association with that. So
agreed 100%. And it's really I think this is like or dislike that if you're a PPO person, or I think more and more employers are going to move to the HSA plan. It puts more burden on the employee to decide whether they want to go to that, because they have to pay that to the deductible first. And I think so. As a employed individual, you might have to get used to doing this, but there's a lot of benefits for an HSA. I now get to take pre-tax a lot of deductions that I always have to pay after tax. And so there's a lot of good things that come out of it to say, and it's not always all bad when it has to happen.
Right, certainly. Are there any other questions that anybody would like to ask or submit? So if you're looking to make a cash purchase in 2022, does it make sense to convert the money into a Roth IRA to prevent both the tax exposure and the risk of increasing your IRMA costs as well? So would this be withdrawing money out of an IRA to fund an expenditure or converting it to a Roth first?
Yeah, I'm not certain with the cash purchase. I guess the cash purchase would be to take out money from the IRA, I guess, yeah. No, it doesn't, because,
So if I'm going to withdraw $100,000 in my traditional IRA to buy a new house,
right.
I want to buy a beach house.
Right.
Is it better to just take that withdrawal and buy the house, or is it better to convert that money to a Roth and then make the withdrawal?
It's probably 6.5 a dozen. What I probably would say is that the better idea is planning. Is to say, okay, I know $100,000. I know I'm going to need it in March of 2022, rather than take $100,000 in 2022 and get myself an IRMA, get myself in potentially a higher tax bracket, maybe make things taxable, and say, okay, I'm going to take 50 now and 50 next year. Right. I think because making the Roth conversion, you're still going to have the IRMA issue, because you're still converting into the Roth does not help. The conversion still counts against your IRMA at the end of the day. And you have to be aware of that. It's certainly something we do when we do Roth conversions. We look at that and say, well, what are the IRMA levels? Where are we going to get hit with that?
So maybe the better option is splitting it between tax years rather than a conversion per se.
Exactly.
Because a conversion will generate income in the same way, essentially.
Right. And so Patrick said it was for a car. Yeah. So I think that if you're going to do it in the first part of the year, and you're not an IRMA issue in 2011, take as much as you can out and to avoid that. Check your rates to make sure you're not going into a new tax bracket rate. But definitely the advanced planning solves many issues in taxes, by taking the split between the two.
That could impact Social Security taxation, Medicare premiums,
capital gains,
tax rates,
lots of different things. So I think it's good to look at that, and if you're going to do it, to make the plan to do it. Yeah, rolling the Roth, you're still going to have the IRMA issue, and you're not going to get much of the benefit. And then if the count ends up going down in that sort of few month period when you need it, you're going to be, kind of biting yourself in the end of the day too.
Right. Okay.
Under that sort of idea, one of the things we talk about right now with this looking at these capital gains and these items like this is investment harvesting. Is it makes sense to maybe get some capital gains in this last month of the year in 2021 if we think we're going to have large capital gains in the future or something like that? Should we pay the taxes today? Look, you can go and get a capital gain. You can buy a capital gain today. And I love my Apple stock, and I have a $100,000 gain in my Apple stock. There's nothing against you selling your Apple stock today, paying your capital gain, taking the $100,000 and buying, turning around.
There's no wash sale.
There's no wash sale rule on a gain, only on a loss. Right. So I can go out and then rebuy my Apple stock, and now at its higher basis, lock in my lower capital gain taxes and take care of it then.
In fact, where that works really nice is for people who don't have a lot of earned income. Because if they keep it under a certain amount, they may pay zero in capital gains. If maybe their only income is from Social Security, or if they just had low income that year, they could potentially get out with no capital gains tax.
Well, even less. I mean, we do this a lot of times with clients, and we'll look at that. And so, we'll do this with clients where they look at it and say, okay, well, the first 50 was tax free, the next 50 was at 15%. So your effective rate was after you take off the standard deduction and everything, your effective rate might have been 7-8%. This is still a really good rate for $100,000 capital gain.
Right.
Pay the tax, move on, and do that.
And what we're referring to here, we may have got a little too deep into that.
Alphabet soup.
I don't recall what the threshold is for married filing joint, but for people who are on the lower end of the tax brackets, up to a certain amount, capital gains are actually taxed at zero. And so it's kind of a double-edged sword, because when you realize the gain, you could get phased out of that, but you still get the zero up to that amount.
And I think the other one they're asking about is the IRMA one, which is, I don't even know what that stands for, but that's the definition of that. So when your income goes over a certain level, those of you who are on Social Security know this very well, your Medicare tax is taxed at certain amounts. So when your income goes over a certain bracket, you get $1 over that bracket, and you move into that new tax amount for the Medicare.
It's the increase in your Medicare premium over and above the standard Medicare amount.
Under the last sort of thing I think of planning is year-end gifting and trust. This is any single person give another person $15,000. So if I am a person that is worried about this estate limit, and I have more than $10 million in my account, grandma's got more than $10 million, start gifting some of the money to the grandkids. If she's going to give it to them anyway, start gifting it to them. Give each grandkid $15,000. If there's 6 grandkids, we just got rid of $100,000. Do that for 10 years, it's $1 million, right? There's no reason to keep that money in there if we're worried about that sort of stuff.
And they're not going to get a tax deduction per se in that year, but that could potentially lower the federal estate tax.
Correct. And it could help out in other ways. It may help them pay off debt. Maybe you'll do some other things, student loans and stuff. To that point, there is no gifting limit on tuition payments as long as it goes directly to the school. Medical expenses, it goes directly to a medical facility, or hospital, or doctor, or something like that. So if you have someone who has those kind of expenses, you can use that. The other big thing we talk about is trust for clients. Right now, if we think the estate limit is going down by half, and we have a client who has more than $10 million, we may put money in a trust right now, take that so we can take it out of our estate. Now, the issue with trusts are, number one, that it will require its own tax filing. It will have its own sort of piece, and it will live past the date of death of the person at the end of the day, unless the trust ends. Right. So there's more to do with that. But look, we're talking, if the estate limit goes from 11 million to 5 million, and grandma has $6 million of income in the estate, we're talking $3 million of tax. The little bit amount it costs to set up the trust, and the little amount you have to do to run the trust will be significantly less than all the tax money we're paying on that $6 million over the course of time. So, so it's definitely something to think about.
Okay. We'll see if you have any other questions here, and
I've got a few minutes in the Q&A.
Any other questions? Okay, thank you for the definition, the acronym here, income related monthly adjusted amount.
Thank you for Google, whoever Googled it.
There we go. Well, if there aren't any other questions, thank you all for joining us, and Derek, thank you in particular for coming on. And I think this is very informative. And I would say that the first things you said was, you don't want anybody to ever say, did you know?
Right.
And hopefully some of these things can be helpful to help people understand what options they may have if they're right for them. And if they're not right this year, maybe there are options in another year.
Yeah, so. I mean, look, obviously we're tax professionals and we do this job for a living. There is a lot of money to be lost or saved, depending on how you look at it, by not taking the time to meet with a tax professional and get that information. We just talked about grandma and $3 million if you don't do the right things. The worry of seeking any professional help, whether it's a lawyer, an investment advisor, an accountant, is the fees that you're going to get charged. Yes, you're going to get charged, but there's a lot of money to be saved here in some of these places. So absolutely. I highly recommend seeking out that advice if you think you need to.
Absolutely.
It either will save you a lot of heartache and when it comes out, or maybe make you feel more comfortable at the end of the day when you don't have an issue.
Well, thank you, Derek. We appreciate it. And hopefully next year we'll still be face to face. I hope everybody else out there is staying safe and healthy. And if you have any specific questions about any of these, please feel free to reach out to me and or to Melissa or Joe or anybody else here at Steinwolf, and we can certainly assist in directing you to the answers for anything that you would like to discuss further.
Josh, thanks for having me. It's been a great time.
You're welcome. Thank you. All right, take care.